Here on Opening Day, we bring you the investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with your big portfolio. Let's get a quick look at what's hot in the markets as we kick off trading and send it down to Yahoo Finance's Ali Canal at the NASDAQ in Times Square. Ali, I know you got a lot on your plate. What are you looking at here?
Well, Brian, markets opening in a sea of green here after President Trump urged Israel to halt its strike on Iran. There's growing hope here that a U.S. brokered ceasefire between the two countries can stick. We're seeing gains led by the tech-heavy NASDAQ up about 0.9%. The Dow was up nearly 300 points and the S&P 500 up about 0.7%. But I do have two stocks that I'm watching closely. And let's kick things off with NVIDIA. We're seeing shares up modestly today. This comes after CEO Jensen Huang sold off $14.4 million in NVIDIA stock over a two-day period. The CEO has a preset trading plan. He could offload nearly $1 billion worth of shares by year end. Now, typically, Brian, this would spook most markets, but not NVIDIA. We're actually seeing shares up about 10% over the past month. So the takeaway here from Wall Street is not fear, but it's faith. Jensen Huang selling his shares because he can, not because he has to. And when you're the godfather of AI, like our friend of the show, Dan Ives, likes to say, even a multi-million-dollar share sale can look like a flex here. So that's NVIDIA. And then next up, I want to take a quick look at Tesla, up another 2% after a successful robo-taxi event over the weekend. And what's interesting here, Brian, is that this looked more like a high-stake beta test than an actual breakthrough, but the stock still surged 8% yesterday. And this tells you everything you need to know about this specific company. Sometimes the hype can drive more than the actual cars can, because over the weekend, we did see some videos that robo-taxis were speeding, that they were veering off into different lanes. So safety concerns, sure, but that didn't really seem to bother Wall Street. Clearly, there's this FOMO rally happening here with success not fully priced in. Investors don't seem to care. We are currently in this AI tech-driven market, so even a flawed rollout can lead to, an $80 billion rally.
Ali, if Jensen's selling that black leather jacket as trademark, I'm buying it. I'm emptying out my tank for that one. Thanks so much. We're kicking off things with your daily guide to the biggest market drivers of the trading day. Here's what we're watching. Number one, the geopolitical risk unwind with Iran and Israel in a supposed ceasefire. Markets are unwinding bullish trades in gold and oil. Does this move have staying power, though? Number two, eyes on embattled Fed Chairman Jerome Powell as we are moments away from his latest testimony to lawmakers. Powell's feeling the heat to cut rates from President Trump and perhaps increasingly from inside his own Fed. Here to break it all down, Callie Cox, Ritholtz Wealth Management Chief Market Strategist, Troy Gayeski, FS Investments Chief Market Strategist, and Yahoo Finance's Julie Hyman. Really fascinating panel here. Good to see you all, you guys. Callie, I want to start with you here on markets. We're seeing an unwind of this geopolitical risk trade. Do you think it has staying power?
I don't think anybody can tell you that for sure, Brian. I think everybody's just following the headlines and seeing what's coming out of Trump's mouth and then what we end up seeing overseas. I hope it has staying power. I think that there are risks if it doesn't. I think that oil can make its way a little bit higher, at least in the short term. But for now, it's anybody's guess. And I think the best way to approach it is to just, not try to chase the headlines.
Julie, I guess what we're seeing here, the unwind, makes sense given the headlines. What are you seeing here this morning?
What I'm seeing this morning is at least some strategists sort of trying to step away from this ongoing situation, saying that it's not something you can ignore, but there's also a lot of other things going on that potentially could be more long-term consequential for the markets, right? And we're talking about things like tariffs, what the Fed is going to do about them, economic growth, earnings growth, et cetera. David Kelly over at JP Morgan Asset Management, the chief global strategist there, again, saying not to ignore this, but saying we really have to refocus on the tariff situation, what effect it's going to have on prices, how sustained that effect is going to be, and then the follow through on the Fed.
Troy, it has to make sense, though, to have a portion of your portfolio in more defensive areas, especially on a pullback here in gold and other safe havens, in what looks to be a summer that's going to be full of geopolitical risk.
Yeah, Brian, first of all, great to see you and Julie and your other guest again. But, when you think about the use cases for any non-beta or equity trade or non-duration, obviously one of the liquid options is gold or crypto. But then you think about alternative investments, whether it's private credit or middle market private equity. One of the precise reasons why you own that is so you're not overexposed to left tail risks that can occur from time to time. So you think about this year, we came in, everyone was very ebullient on the Trump administration's pro-growth policies, and then it's whoops, like Liberation Day happened, right? So not having that downside, not being forced to make perhaps the wrong decision at the wrong time. And then, of course, the geopolitical risk has been actually more benign, I think, than most of us thought, particularly in oil, right? I mean, oil barely surged at all relative to past Middle East conflicts. And now you're seeing that unwind. So to your point, going through the summer, a lot of uncertainty on tariffs, although we think at the end of the day, the economy will plow through it. Stretched valuations in equities, albeit with reasonably good fundamentals and even better technicals. So having some portion of your portfolio that can grind out positive returns when either equities or fixed income are struggling is a very important use case for alternatives.
Callie, why do you think markets have been so resilient off all this news?
I think it's an expectations game. I think this bounce has been mainly sentiment driven. We haven't seen it confirmed really by economic data. Although I somewhat agree with Troy that I think investors are comforted by the fact that the economy hasn't fallen apart, and that goes back to having low expectations. But it's a tricky environment. I mean, we're leaning a little more defensive, looking into value as well, because quite frankly, the economy is taking on a lot of pressure, including potential pressure from oil prices and geopolitical noise. And we're not sure what straw could break the camel's back, but we want to be prepared if so.
Julie, I'll get to you in a second, but Troy, what do you see a straw that will break a camel's back this summer? If this isn't going to do it, what is going to do it?
Yeah, so again, I think one of the things that folks struggle with the most, regardless of what your position is in financial markets, is just how resilient the U.S. economy is to various shocks. And that's principally because, we're a service economy, we're a consumption economy. And even though the labor market has weakened and the consumer doesn't have the firepower to consume like they did a year or two ago, the consumer is still in a very good place relative to history. Debt service ratios continue to come down. Debt levels to disposable personal income continue to trend down. The labor market is not as strong as it was, but it's still strong enough to drive consumption. And importantly, if the labor market had never weakened and we were still in a position we were 2 years ago, it would be impossible for the Fed to get inflation in that 2 to 3% range, which is really the new target, as much as they don't like to articulate that. So very hard to break the U.S. economy, but clearly, a dirty bomb, some type of Chinese invasion of Taiwan, or another pandemic-like event would be enough. But fortunately, those look like improbable outcomes, at least right now.
Well, Julie, I guess the resilience, maybe we could boil it down to investors still hopeful on the Trump economy, no?
I mean, I think if not hopeful, there is a lot to be said for psychology in this market, right? And the fact that when we had President Trump first come out with that list of reciprocal tariffs and the sort of drop in the markets that we saw, the drop in market psychology that we saw, that marked the low point for markets and that psychological sort of vibe, anything that is not that, it seems to be better, right? Seems to be that we're sort of having this melt up based on the fact that it is not that worst case scenario. And I think really, since that was the pivot point for everything this year, that is an important time to remember, and remember that a lot of the optimism that we have seen is sort of a lack of that terrible scenario.
I can't believe you're sounding bullish on the Trump economy, Julie. I thought I would have got you there. I would have got you. You would have thrown your computer up in the air.
No, but that's actually not what I'm saying. It's not a bullishness.
Okay.
It's a lack of terribleness, right? It's the avoidance of the worst case scenario that has persisted here. Are things getting better from here? I think that still remains to be seen.
We're also watching the Federal Reserve, moments away from Jerome Powell, Fed chair, testifying in front of lawmakers. Could that be the straw that breaks the camel's back, Callie, that we have a Fed chair that continues to say, look, we're not cutting rates. Get over it. Get over yourself.
Yeah, I wouldn't consider that necessarily the straw that breaks the camel's back. When I think of that phrase, I think of shocks. especially unexpected shocks. And I think the Fed chair has made it very clear that the Fed is in a stuck position right now. I was more interested by the Fed speak that we heard yesterday. We had Bowman, we had Goolsby, and we had Waller actually last week come out and say that they would be open to cutting rates in July if inflation slows down enough, which shows some willingness among the committee. And remember, Powell's the most important voice here. But there is some willingness among the committee to look at the weakness in the labor market, which I am worried about. But the way that I think about the Fed is that it's just another lack of support beneath markets that we haven't been acquainted to for a while. You know, if we see a sell-off here, if we see the labor market break down, but there are still worries about tariff-fueled inflation, the Fed can't help us. The Fed can't provide that undercarriage to the economy that everybody's used to.
Troy, last 30 seconds to you. Why won't we get a rate hike this year?
There's been no chance of a rate hike for quite some time because, again, you've had a continuing weakening of the labor market. The best way to think about it is we went from a white-hot labor market, arguably the strongest labor market we've ever had in a non-wartime economy, to first warm, or I should say red hot, from white hot to red hot, and then warm. And that's where we are today. So, if you remember last year, there was an inflation scare and there were some people articulating that, the Fed's not going to cut, they're going to hike. But that never made any sense at all, and it still doesn't now. Our thoughts are that the Fed will have enough data to cut by the end of the year, somewhere between 50 to 75 basis points. But in the short term, as was articulated before, if there's another risk-off event or something geopolitical, it's going to be much harder for them to support markets until we see improvement post-tariff implementation of inflation data.
You really shocked me, Julie, with this Trump economy. We're going to take that offline. We sit near each other, so we'll take it offline. I'm just got to rope you in a little bit more. I will leave it there. Everyone stay right there. We'll be back with more opening bid and our stock of the day. Your clue on that stock, you probably just spent $8 this morning on their product. You really should get this one, guys. Welcome back to Opening Bid on Yahoo Finance. Let's toss up the major averages on the screen as the backdrop for stocks has changed quite a bit the past 24 hours. Seeing green across the screen, Dow leading the way as really investors eye what is happening over in the Middle East. Seems to be a little bit of a reprieve for now, but of course this news flow is fast moving and could turn on a dime. All right, now let's dial up our stock of the day. Of course, drum roll, that is Starbucks. Chinese financial magazine Caixin reporting late Monday, Starbucks is looking to sell its entire China business. A source familiar with the matter tells me Starbucks is not currently shopping its entire China business, and Starbucks is giving us a statement saying they see significant long-term potential in the market and are evaluating the best ways to capture future growth. Now, here's what Starbucks CEO Brian Sozzi told me about his ongoing view of the China business a few short months ago.
A lot has changed in China since the last time I was there for a visit. And obviously, the competitive environment has changed pretty dramatically just in the last couple of years. The macro environment is very different than it probably has been historically. So the good news is I believe there's still tremendous growth, both in the coffee category and then the positioning in the space that Starbucks plays in for the long term. I do believe we have to figure out what is the best approach for us to capture the growth that is coming, I think, in the future. And that's what we're evaluating, and that's what I've alluded to as it relates to taking a look at strategic partnerships.
Still with me is my roundtable of pros, our very own Julie Hyman, Ritholtz Wealth Management Chief Market Strategist Callie Cox, and Troy Gajewski, FS Investments Chief Market Strategist. Julie, want to go over to you. We were talking a little bit here in the Yahoo Finance newsroom. If it matters to Starbucks shareholders, they unload this China business. And I think you brought up a very good point that, look, U.S., and I'll say this pun, the U.S. is still stirring the drink for Starbucks.
If you look at the North America business for this company, Soz, it accounts for about 3/4 of overall revenue. That's North America alone. China's about an estimated 8% or so of the business. So if you look at the North America comp sales, that's where Brian Nichols' attention needs to be, right? We have seen that drop off in sales, and we know that he is addressing it, right? He's trying to improve what Starbucks calls throughput in the stores, how fast and easily the gears work, how quickly you get your drink, etc. So he is addressing saying that. That's not to say you can't do two things at once, but this is really the bulk of the company's business. Yes, Starbucks needs to focus on China, even though it's not a huge portion of the business. It has the potential to grow quickly, has the potential to be a long-term growth engine. But right now, it's a little bit of a sideshow compared to the bulk of the business here.
Callie, you're long-term investors at your firm. Is the China business for Starbucks a sideshow? And for those interested in Starbucks, is it that U.S. business that still drives the multiple on this company?
Well, Brian, I want to be clear. We're not stock pickers over at Ritholtz. We're not saying we're taking Starbucks out of here or we're adding Starbucks to this portfolio. But we are, of course, looking at the macro environment. We're thinking about consumers. And look, I read the headlines. I see what Brian Niccol has to go through day after day. Starbucks has a lot of stuff on its plate, as Julie alluded to. And look, if there's a business that isn't performing as well, that isn't, taking up as much share as it normally did, and China is in a tough spot. I think it's hard to argue against that. Then, yeah, it wouldn't surprise me if, Starbucks made moves to shed there. The other thing I'll point out is that we are in a slowing growth environment. And this is where you see this type of corporate activity where CEOs and C-suites take a step back and they ask themselves what parts of the business are doing well versus not doing well. You typically see more spinoffs here. You typically see a focus on, business lines that tend to do well because you can't afford to, spread your wings or expand.
Troy, you, I think, are like me. We put a little whey protein in our coffee, right, and hit the gym.
That's right. You got to stay in shape, right? Especially as we get older, Brian. But,
no, I knew I always liked you, Troy. But look, isn't the bottom line this? I'm trying to figure out the appetite to own Starbucks. This is, at the end of the day, this is another high multiple stock that trades at a higher multiple relative to the S&P 500. What is the appetite to own these types of companies in a backdrop where we have geopolitical risk? We can get more reciprocal tariffs in July. The setup seems horrible.
Yeah, I mean, it's a great point. I mean, when you think of the threat to markets that the trade war had, it was much more impactful on the potential for S&P margin degradation as opposed to the expectation of growth this year. And when you look at U.S. multinationals, there's a key reason why they're refocusing, in this case, Starbucks, on focusing resources on U.S. because the U.S. is the greatest economy in the world. We've had the best nominal GDP growth by far of developed nations. Even though the economy is softening, we're still going to lead developed nations dramatically. And so the setup from a margin standpoint, can you get margin growth overseas? Is it worth the brain damage versus refocusing on your core market, which is stronger? And that, again, is one of the reasons we're so excited about the middle market and private equity, because there, the vast majority, if not all of the revenue comes from the greatest economy in the world, which is the US. And you have very little margin pressure coming from cost of goods sold overseas, or from a lack of revenue growth or revenue at all that you could end up with in a more protracted trade war. So, a lot of advantages to complementing, U.S. multinational exposure, market-weighted indices with private equity, particularly middle market private equity right now.
I know we're 2 days into the show, but y'all are my favorite panel so far. Julie Hyman, Callie Cox, Troy Gaske. Good to see you, and stay cool out there. Pretty hot day.
You too, Brian.
For today's Power Player, I had the chance to sit down with T-Mobile CEO and Starbucks board member Mike Sievert. Here's what stood out to me. First, Sievert pushed back on a recent report that he would be leaving the CEO role early. Plus, T-Mobile confirmed the launch date of its new Starlink satellite service called, appropriately, T-Satellite. Here's what he had to say.
That report was a bit overblown, and so they got a lot of things about it wrong, including the idea that anybody's made any decisions about leaving anytime soon. But they didn't get wrong one thing, which is, yes, we did recruit Srini with the idea of succession planning in mind. And I would tell you that any business should be thinking about these things. That's not bad news. That's good news. Every big move I make in the people arena is about making sure that the secret sauce of this company is here for the long run and will outlive any of us. And bringing Srini on was a part of that story. He is a fantastic leader that turned around a major German operation as CEO, and he's already adding great value here. But that is not to say that there's been any decision by me or anyone else about me stepping away anytime soon.
T-Satellite News. It's supposed to launch commercially July 23rd. What is this service? What will it let you do?
Well, it's the largest satellite to cellular network in the world. And we've been talking about this future for almost 3 years now when we first unveiled it from Starbase in Texas in August of 22. Back then, it was a tech alliance that we had a dream of inventing a technology that meant one simple thing. If you can see the sky, you're connected. This is the end of dead zones. And do you know there's 500,000 square miles in this country that are not reached by any cellular network, not AT&T, not Verizon. And so now, this is about bringing that service to the American public, and we're opening the doors to everyone. T-Mobile customers get it for free on some plans, but anybody, T-Mobile, AT&T, Verizon, doesn't matter. Anybody can have it for just $10 a month. It's built in to our Experience Beyond plan, which is in our most popular line of plans, to Go 5G Next, our previous flagship plan, and for everyone else, it's just $10 a month. And think about the peace of mind of being reachable. Because, the way this works is it works with the phone you already have, by and large, and it connects automatically. This is very different from anything that's come before. So you don't know if you've fallen off the terrestrial network, and it won't matter because your phone will automatically connect to the satellite without you doing a video game of trying to connect. And that way you're reachable. And we found in the beta with over 1 million users that over 2/3 of the messages were actually inbound messages from others trying to reach you when you're out in the wild.
Recently, Mike, T-Mobile launched a 5-year price lock for its phone plans. Definitely, I think, surprised a few folks in the industry, shook up in the industry. What have been some of your learnings since the launch?
Well, people are concerned. And there's a lot of uncertainty out there in the world. Prices are up in everything. They're up in telecom as well. And they want some assurance from the value leader, which is T-Mobile, that we're going to have their back. And value comes in multiple forms. One form is the price you pay. And now the price you pay won't change for 5 years.
Why are phone plans so high?
Well, I would say it the other way, which is why haven't they risen? In real dollars, you pay the same amount now you did in 2019 for phone service on average, but you're consuming 3 times more data at 4 times the speed. That's the 5G dividend. The American consumer, not T-Mobile customers, the American consumer is consuming 3 times more data at 4 times the speed for the same price in real dollars. Name another industry that's delivering that kind of value.
Guess I can't name that industry. Now here's my final thought for your trading day. Fed Chair Powell's testimony to lawmakers will begin shortly, and you could see a more hawkish Fed chair. Why, you ask? Oil prices are up 18% since the early part of May, or the May lows. Tariffs are in place on things like steel, and more tariffs lurk in July as the 90-day pause could lift. Powell knows all of this, folks, and could begin to communicate more clearly that rate cuts are off the table. Food for thought. That does it for Opening Bid. Coming up, Yahoo Finance's Market Catalysts.